Well, let's dive in. We're going to first start with what to do when your nest egg reaches $250,000. So what to do when you reach that $250,000 mark. And I think there's a handful of topics surrounding the sum of money, the value, but really it's not just about the 250. It's, looking at the future with that $250,000 and what can I now do to best steward this and improve it as best as possible. Yelisey, do you want to kick us off with point number one?
Yeah. So the Federal Reserve, they have a survey of consumer finances, and they actually, they report on average how much people have in their retirement savings, their retirement nest egg, and they break it down in a number of different categories. But one thing I thought that was interesting is $250,000. Like, when does that happen for most people? We're on average, we're meeting retirees, on average 59 plus, I would say. Our average client is 65. But according to the survey, those between 45 and 54, on average, had accumulated $254,720. Of course, this is an average, so it doesn't represent any one individual person. But that's what they had accumulated according to the survey. So we're talking to people between the age of 45 and 54. Now, that's a critical time to be looking at your retirement nest egg, because retirement, it's not necessarily around the corner, but it's important to start getting things right in those years, because there really isn't as much time as you think there might be. I was born in 1989, and the average retirement account savings for someone in 1989 was $87,000.
Wow.
I mean, of course, we've had a lot of inflation, but today the average is actually, if you don't look at any age category, just on average, what do people have in their retirement savings across all age categories? It's $333,000. So a lot has changed between now and 1989.
Wow. So the $330,000, that could be somebody, you're counting in the 25-year-old and the 85-year-old.
I'm counting, including people that have already entered the distribution stage of retirement.
Yeah.
They're already pulling on the retirement savings. So
Interesting.
Yeah.
Interesting.
But, one of the most important things to do, and there's a lot of articles on diversifying your retirement savings. And I guess I would say be careful, because we get this question all the time. I have a 401k. How can I continue to max out my 401k, do whatever I can at work, but also I want to contribute to my traditional IRA or my Roth IRA? What are the advantages and disadvantages to doing both? And one of the things that I want to know is you can certainly contribute to a 401k and an IRA. But the one thing to keep in mind is if you're actively contributing to an employer-sponsored plan, your IRA contributions might not be deductible. So you actually lose the tax benefit. You can still do it, but the alternative is putting the money into a Roth IRA if you can. But just to kind of break it down a little bit, if you're married and you currently contribute to a 401k, your IRA contributions will not be deductible if your modified adjusted gross income exceeds $143,000. And to further complicate things a little bit, imagine if you're married once again, but you don't make the employer plan contributions, but your spouse does. Well, then you can make IRA contributions as long as your modified adjusted gross income does not exceed $240,000. So there's all kinds of rules like that that could trip you up, especially if you're not dealing with this sort of thing on a daily basis.
Yeah, not confusing at all.
There's more to it than simply knowing the contribution limits, which of course those are important to know too. Most people are taking advantage of the 401k. The contribution limit is set at $23,000 for 2024. And if you're over the age of 50, as many of our clients are, that gives you an additional $7,500 catch-up. With an IRA, the limits are a lot lower. We're talking $7,000 this year and only an additional $1,000 if you're over the age of 50 as far as the catch-up provision goes.
Yeah. So not talking about the taxation, I want to talk about that in just a moment, but Yelisey, would you say considering a Roth 401k if that's available to an employee, is that a good idea?
Well, what I often tell people is if you could pick, you would have all of your money in the Roth IRA. Yeah. There's clear and obvious advantages if you could simply pick. But there's a conversation to be had here, because on your traditional 401k, your traditional IRA, you get the tax benefit this year. If you make a contribution, you're reducing your taxable income. You're deferring your compensation. You're saying, hey, I'm not going to take this money home. It's not going to be income, but it's going to be deferred compensation. With a Roth IRA, you're kind of biting the bullet. You're saying, no, instead I'm going to introduce the income this year, but I'm going to put it away into a Roth IRA or Roth 401k in your question. And you do have to pay the taxes on that income. That money that you put, the contribution is considered after-tax dollars. The nice thing is, eventually that money is going to grow, and the idea is you won't have to pay any taxes on any of the growth. So in the earlier years of retirement, that might be fantastic. You might actually, really benefit from that. The thing to consider is eventually if your income grows, there are contribution limits based on income. So if you're single and you make more than $153,000 in your modified adjusted gross income, you can't make a Roth contribution. If you're married, that number is $228,000. So it doesn't necessarily double just because you're married. And a few podcasts ago, we discussed some of the marriage penalties within our tax code, if you will, and that could be considered one of them, right? It doesn't double just because you're married, but those are the limits. So for many folks, their income continues to grow and they can't make those contributions. And then in the earlier years of retirement, they really like the deferred compensation, lowering their tax bill when the income was low and they needed every dollar. So there is a little bit of a catch-22 there.